Hello, everyone. I'm Carolyn and welcome to the first of, I hope, many installments of a video education series. And joining me today is a trusted business partner that I've been working with for the entirety of my professional career in real estate, Sharon Eastman from Big Horizon Mortgage. And we're going to talk to you a little bit today about rates and risk in mortgage lending. And Sharon, can you just start us off a little bit by telling us how long have you been doing this? How long have you been in your, have your own business?
Well, I started doing mortgages in Maine in 2001, and I opened my business in 2003. And so that's about 19 years that I've been doing mortgages in the state of Maine. I've been doing reverse mortgages for about 15 years of that time period too. So I do all kinds of residential lending. So that's every kind of residential property, 4 units and under. And reverse mortgage is a different kind of mortgage where somebody already owns their home and uses their home to fund their life. So we don't have to get into that today. But
Right. That's a topic for another time. But you and I have done many forward mortgages together. And I've helped with clients that have had reverse mortgages and we're selling.
Yes, you have. Yeah.
So not always easy. But so let's start by tell me a little bit about what you've been seeing over the last couple of weeks in the mortgage industry and how that is affecting our consumers.
So today is April 9th, and that's just important to mention because there is so much change going on in the financial markets, in the mortgage markets, with the virus, with people losing their jobs and different changes happening every single day. So right now, about 3 or 4 weeks ago, when the travel ban started, there was a lowering of interest rates on the Fed's fund rate, which people mistakenly think is their mortgage rate, and it's not. So we had a lot of people in process already refinancing because rates had been super low over the last couple of months. In fact, the statistic was something like nationwide, there were as many loans in process in the last 2 months as there were done all of 2019.
Wow.
Kind of crazy. So we had all those loans in process across the country, all different kinds of lending. And then we had the virus, the travel ban, and the financial markets and the lowering of the interest rates. So it was kind of a crazy time, a crazy couple of weeks. So what really happened, here on the ground was we were just working to get everybody in our pipeline completely closed and done. So there was no risk to their loan or their rate or anything like that, because there were days over the course of a couple of weeks where rates went up dramatically, then down, then sideways, a little bit of everything. So it was a little precarious. So been working really hard to get everything closed. And now we're kind of past that. We have a group of new customers refinancing and purchasing that are, as we're all trying to get used to a little bit of a new normal of where are rates and what are the new requirements and things, especially with people, losing their jobs. And so it's been a daily, very, very fluid situation. So I'm reading and learning every day about the options that are out there and the changes that are occurring, and making sure that my customers know about them too.
Sharon, can you tell our viewers what affects mortgage rates? So while the stock market's going up and down and the Fed's adjusting their rates, what is it that exactly affects our mortgage rates? Just sort of in a snapshot, if you could.
So simply, lenders lend money to make interest, and interest rates are developed by lenders based on the risk parameters of the borrower, of the individual who's borrowing. And the risk parameters include things like your loan to value, how much of your home's value are you borrowing, your debt to income, how much of your income is being used to carry your housing and other debts, the purpose of your loan, whether you're buying, refinancing, cash out refinancing, the type of property you're borrowing on. So whether it's a multi-unit investor property or a single family home or a second home. So, and then of course your credit score, which everybody's heard of, how that impacts your lending. But all of those things get put together kind of in a, recipe. And what comes out from that is your interest rate, which is directly associated with your risk. So a simple example would be if you were buying a house with 20% down and you had an 800 credit score, and I was buying a house with 20% down and I had a 660 credit score, you and I are going to get very different mortgage interest rates. If everything else was the same, we made the same money, we had the same debts, everything, we would get very different interest rates. So, one of my favorite questions is people always say, what are rates right now? And, that's an impossible question to answer because I have to know your situation to tell you what rates are.
Okay, good to know. So it's really, all that aside, that recipe, right now, what we're looking at is it comes down to risk, right? That's what the lenders are looking at in a bigger way than normally. So tell us about that, how that's impacting it.
Yeah, so at different times in our world, risk is greater. And right now, one of the things that lenders are very sensitive to is whether you have a loan in process and you have just lost your job or you're about to lose your job. That impacts underwriting. So one of the overlays that we're seeing, so an overlay is just something additional that we have to do, is we are seeing not only a verification of employment verbally by calling your company within a few days before the closing, but if it's a purchase, we call on the day of the closing. And if it's a refinance, we're calling during the 3-day rescission period to verify that you are still employed. That's totally new. That's something that we haven't had to deal with.
Okay. Are there situations where somebody may be partially employed at this point? Some companies have cut people's hours back and they're
I have
still
someone
employed,
like that right now.
and they might be fully employed again in a month, but how is that impacting their ability to borrow, or if they're in the process of a loan?
Well, in some cases, it will make it so that it can't be done right now, just because the lender is going to do the calculation based on your lower income, not on what you're going to make, what you did make, and what you're going to make later. But I do have someone right now in process, and they provided a company-wide a communication that said that we're going down for 5 weeks to a 4-day work week. And it's across the board from the CEO all the way down. And I just provided it to the underwriter because even with the lower income, the individual is still qualified. So let's say it's 2 people borrowing, 1 person loses their employment. It still might be able to be done on the first person's employment. And it still might be able to be done if your employment's cut a little bit. But I mean, if you are unemployed or furloughed, not taking money in, you can't get a loan.
Okay. Good to know. I mean, so it's not a total wash depending on the individual situation. Yeah. Okay.
And of course, there's a lot of people in this situation right now whose jobs are very secure.
Right. Yeah. So what types of loans are most available at this point? What are you seeing from that standpoint?
Well, it's almost like flip it the other way and say which kinds of loans are less available, maybe, because they're probably have, and less available might not mean that they aren't available at all, but maybe the guidelines have gotten a little bit tighter, something like that. Mm-hmm. So some jumbo loans, we've seen rates go up there because jumbo loans tend to be greater risk. They don't have the backing of Fannie Mae and Freddie Mac. So I've seen some lenders raise their rates there and tighten up their guidelines a little bit. What's called non-QM, which is non-qualified mortgages, which without getting into the details, that is a more risky loan, and those are less available, if available at all. But Fannie Mae, Freddie Mac loans, those are all available. It's all about how might the guidelines have been tightened a little bit. Maybe your credit score has to be a little better, or something like, or maybe your debt to income has to be a little better, something like that.
So you and I, a lot of the transactions that you and I do are what we call portfolio loans, and they're for specialized properties that are common to this marketplace, like seasonal camps or seasonal summer cottages and condo hotels. And they're usually coming from smaller local banks. What does all this mean for a portfolio type loan for that type of a product?
So as of today, I haven't seen anybody pull those kinds of properties. Now,
Okay.
whether they might say, oh, we're no longer gonna take a 10% down payment on something. We would like a 20% down payment on something like that. Those kinds of things can happen.
Okay.
But I haven't seen anybody say there's not a particular type of property we're not lending on.
Okay. So the small banks have not become risk adverse at this point
I've seen some guideline changes. I have. The thing about local banks and credit unions is that they all have a personality, and they have their own risk tolerance and kind of risk profile. And so some of them have made some changes. That employment piece I was talking about making sure to, calling. The other thing that I've seen is any sort of proposed rent. So if you're buying a 2-unit and you're going to live in one, and the other one is a proposed rent of whatever, $1,200. Unless there is a lease in place and somebody living in there, they're not going to count that rent, proposed rent. So then you're going to have to be able to carry the whole thing on the investment on your own income without that rent coming in.
Because rents are key at this point.
Well, obviously, I mean, people are not.
Yep.
That's what's happening.
Yeah. And I think as you and I were chatting the other day, one of the things that you mentioned about cash out refis being a little bit more fluid insofar as rates and what those rates look like. Can you tell me a little bit more about that?
Yeah, it's interesting. So a cash out refi is where you refinance your regular mortgage and you take some money out. So let's say, normal times you might have taken out 30 grand to build a garage or something like that, increasing your loan amount by $30,000 to get that cash out. Now a strategy might be for people to take cash out to have a little bit of money in cash, in their reserve account, and also cash out to maybe pay off any of their bigger bills, for example, a car or something like that. Cash out rates tend to be a little higher than just straight what we call rate and term, which means you're only just doing your refinance to change your rate or change your term. But cash out can be a good strategy right now, and it's still available. It just depends on the situation and how much money somebody might want to cash out and how the rates fall.
Okay. The rates have been up and down. I know you said they've stabilized a little bit, but when are you locking people in at this point? Is that more open than it was? Are banks giving people or you the opportunity to maybe lock them sooner, or depending on where the rates are?
So I have heard across the industry that there are some lenders that aren't letting you lock up front, and that they're waiting till you're underwritten or something else, or within 10 days of closing or something like that to lock. That's not something that I've seen with any of my lenders yet. Okay. So I am able, if I took an application today, I can quote a rate right now, and I can lock the rate right now.
Oh, awesome. Great.
One thing that a couple of lenders have done, which is great because some of the appraisals are taking a little longer, that sort of thing, is they're giving you 60-day locks with no additional charges or anything like that. Doesn't mean we have to wait 60 days to close, but it's giving flexibility if it did take a little longer.
Okay. All right. Yeah, appraisals have been a little bit challenging. Is there anything else we're missing? That we didn't cover that you think might be important?
Well, FHA appraisals and my reverse mortgage business, they've been given the ability to do exterior only appraisals, which is really nice because that clientele is older and they don't necessarily, nobody wants anybody coming into their houses right now, and the appraisers don't want to go in your house right now. So that's been
there are guidelines around appraisers and how they can go into properties, but that's nice that they
for FHA. And then the other thing is that Fannie Mae and Freddie Mac have really expanded their parameters for for people getting appraisal waivers. So we're seeing more appraisal waivers. In
Oh,
fact,
awesome.
the last 2 applications that I took, one is a cash out refinance and one is not.
Okay.
One's in South Portland, the other one's in Kennebunk, and both of them got appraisal waivers.
That's great. That's huge.
Yeah,
So,
so it's a savings of money, first of all, because it's anywhere from $575 to $650 for an appraisal.
right.
But it's also a big savings in time. We can close you quick
Because
because we don't have to wait for that.
you're not waiting. Um, so I think, one of the things that we working together as a team, and it really is a team effort between myself as a broker and you as a lender and the borrower. um, Everybody has to be flexible, and because these are challenging times. But what was the quote that you said when we started this? Go ahead.
In challenging times, or all challenging times, always bring opportunity.
Correct.
And there will be opportunity for buying real estate. There'll be opportunity for personal growth. There'll be opportunity for family time. So there's opportunity out there. Quality family time.
And
There's
one of the
great
things,
opportunity.
yep. One of the things that we're seeing is, yes, we still have low inventory, and there's not as still, there's particularly now, there's even less coming on, but there's fewer buyers. So if you're in a position to buy, and have the means to do so, you might not find as many properties that are going to be in multiple offer situations in some marketplaces. So, and so yeah. Anything else? Can we leave any other pearls of wisdom we can leave people with?
Just that things are changing day by day and it's fluid. And, when you do, when people make offers and when people talk to their lenders and talk to their realtors, you gotta have super communication right now and understand that things are fluid, and we're all in, new territory.
Correct. And you know what? And as I was trying to wrap this up, I had another thought. So from a lending perspective, we were in like a 30 to 35 day window to close. Do we need to think about stretching that window?
Depends on what kind of loan it
Okay.
is.
Right.
So I would, if it was a portfolio loan, yes, you're probably looking at 60 days because some of the local lenders and banks are just slower and they have less people. And then, like I said before, with some of like my refinances, they're going fast because they're getting an appraisal waiver. So it depends. I think your contract needs to be at least 45 days, or say 45 days, and know that there might have to be a week extension if you are doing a purchase contract.
Okay.
I think if you did 30 days, you'd undoubtedly have to do an extension in the end.
Okay. So the message we're leaving everybody with is that there definitely is opportunity if you have the means, and just remember to be flexible, and communication is key. So
Absolutely.
thanks, Sharon. We'll talk
Thanks,
again
Carolyn.
soon. Bye.
Bye.